Welcome to Sectors Up Close. I'm Elena Casas. Today our topic is European natural gas prices, and my guest is Bryan, Director of European Gas Research at the London Stock Exchange Group. European gas prices have been on a downward trajectory all year. The benchmark is trading around €32 per megawatt hour, down from over 70 at the beginning of the year. They're down 90% from their peak last year as the war in Ukraine choked off supplies of Russian gas. Prices are being helped lower by stronger supplies from Norway, while flows from Russia to Europe via Ukraine remain stable. According to recent data, European storage sites were 79% full on the 4th of July, compared with a 10-year average of 60%, while a feared spike in demand from China hasn't materialised. China's imports of liquefied natural gas did rise to a 5-month high last month, but tepid demand in the rest of the continent has kept a lid on spot prices. That surge in Chinese buying was put down to a drop in prices to below where it can compete with domestic supplies. Well, for more on where prices may be headed, I'm now joined by LSEG's Bryan. Wayne, hi, thanks for coming in. We do seem then to be in a more positive place than we thought we might be at the beginning of the year, where gas storage in Europe is fuller than perhaps was expected. How did we get here?
Really a combination of factors, really. I think, firstly, you mentioned at the start of the year there was still quite a lot of fear. We had 3 months of the winter remaining. Storages were not in the greatest position. But what we saw over the next couple of months, and even actually towards the end of the year, was demand was really weak compared to historical averages. That was a combination of warmer weather, consumer behaviour towards energy consumption has changed. A lot more people are a lot more wary of how much energy they're actually consuming. Smart homes, etc. contributed. We had strong levels of LNG, stronger levels of the renewable, and chiefly industrial demand destruction was really strong, way stronger than most of us ever envisaged at the start of winter. And I think the combination of these factors, in tandem with softer Asian demand, as you mentioned, helped Europe become the beneficiary to receive a lot of LNG, which in turn helped us fill our storage levels. So a combination of factors, really.
You said demand destruction from the industrial sector and consumers has been crucial, but do you expect that to continue? Is it a permanent behaviour change?
That's something we're looking into now in terms of research and ahead of our winter outlook, and we still believe there'll be some demand destruction present next winter, but we still believe it will be higher than last winter by at least 7%. Now, it depends on several factors: government support for energy bills, and of course, has consumers' behaviour, is it permanent? Now, you can look at different factors. Again, I mentioned the smart home. I mentioned a lot of people have just changed their behaviour, but we didn't get the real test of a freezing cold winter. So I think we'd need to see a real test of a freezing cold winter to accurately say, has demand destruction, is it here to stay? Industrial demand's another factor. At the moment, prices have fallen, as you mentioned, back towards €30, but we've not seen that big rise in industrial production. Some of that production has actually moved overseas, US in particular, attracted by tax subsidies and, of course, access to a lot lower natural gas.
With prices lower at the moment, is there a risk of complacency?
I think, yeah, there has been some complacency. I think a lot of people think, oh, we'll be fine with storages. As you said, we're close to 80% versus 62% this time last year. We see storages being full ahead of the target on November the 1st. So it might be a slight bit, but looking at the winter price now, you can still see that bit of risk. But I think people need to be aware that just because we got through last winter with such ease, there is still a lot of risk on the table for the coming winter, and the current spreads indicate that as well. And I think the closer we get to winter, you're going to start to see some of these factors start to become more apparent. And then it will depend on supply. How strong will the supply be? Will there be any interruptions in Norwegian supply, which of course is happening at the moment, where we're losing quite a lot of volumes due to maintenance. So there's a whole plethora of things that can really impact the price. But I think as we get closer, we get a bit more of the weather forecast become a bit more accurate. I think we're going to start to see the prices sort of take their shape as we go into winter. But there's still quite a lot of risk remaining.
Is there also a risk to infrastructure?
Yes, for sure. And I think we've seen recent announcements by Norway and the UK. There was a joint press conference with the defence ministers, and subsequently we've set up a control centre actually in the UK specifically to monitor our underwater infrastructure. That includes gas pipelines. As you know, we have 2 pipelines that connect us to Europe. We've also got a vast, communication lines. You've got all the gas producing platforms in Norway and in the North Sea. Now, God forbid if there's any damage to any of these in the midst of a cold winter when supply is already tight and the market's nervous, we could see prices really, really rocket. So it's quite good to see that already plans have been made to monitor that. But it certainly could be a risk depending on how the conflict develops.
Wayne Bryan, Director of European Gas Research at LSEG, thanks so much for joining us. That was our look at European gas prices. I'm Elena Casas, and this is Reuters.